You can think of knowledge as the new currency. It really is what you build everything on. You don't educate yourself, you're essentially doomed to follow other people's advice. And the problem is you don't know if the advice you're getting is good or bad. And then you don't even know what kinds of questions to ask because you don't know enough to ask intelligent questions.
Welcome to the Bulletproof Cashflow podcast. Let's get into the show.
Hey everyone, this is Agostino. We're creating a real estate portfolio. We're looking to create passive income along with overall net worth. These are the basics when putting together a wealth plan. It's about applying actionable advice for making money in real estate in any market and avoiding the common and awfully costly mistakes as well. Well, today's guest, he understands how to grow a real estate portfolio, as well as making it his personal mission to help other people create financial freedom by taking the guesswork out of investing. He and his team structure complete turnkey real estate investments to minimize risks and to maximize profits. As the CEO of Norada Real Estate, he and his team dedicate their time to researching top real estate growth markets. He also hosts the Passive Real Estate Investing podcast. With all that, I'd like to welcome Marco Santarelli to the show. Hey, Marco, thanks for coming on, man.
Agostino, hey, it's great to be here. Thanks for the invitation. I'm excited to talk to you and your audience.
Yeah, me too. It's going to be great. If you like what Marco has to say, you can reach him via his website at noradarealestate.com. If you like our content, please don't forget, leave a comment and please rate the show. It helps us out tremendously. Finally, if you text the word freedom to 202-410-4202, you get a free ebook, The Bulletproof Guide to Finding a Broker. Okay, Marco, go ahead and tell the listeners about how you got your start in the whole real estate game.
Well, interestingly enough, before we started recording here, we were just kind of chit-chatting, and I come to find out that you were originally from Canada as well, as I was. So my start in real estate actually happened in Calgary. That's when I bought my first rental property when I turned 18. And I was just excited about real estate, but I had to wait until I was 18 to qualify for financing. But it was the time in my life that the writing was on the wall, because that first rental set the trajectory for everything I was going to do going forward. But, it was a pretty much textbook thing. I bought this rental, I fixed it up, I put a sign in the lawn. There was no internet back then, so you couldn't advertise online. You stick a sign in the ground and you put it in the newspaper. But I leased it up and I managed it myself. And then years later, I made the mistake of selling it. And I call it a mistake because I didn't know back then that what you should do is take that equity and leverage it up into more and more real estate and build your portfolio that way. So, consumer mindset, don't do that. If you're listening to me talk about this thing, just learn to reinvest and leverage your equity into more cash flow. But that's really where I got my start is way back then. Today things are a little different. Much larger portfolio. It is geographically diversified across the United States, which is one of the things I talk about quite a bit is geographic diversification, just to be completely market agnostic. But I love to teach and help other people. I want to help other people do what I've done. I want to help other people create financial freedom, just like you're doing. And how do you do that? Well, you give back, you educate people and show them the way, help them understand what to do, what not to do. Don't step on the same landmines. But just to kind of finish answering your question, how this all came to be was in 2004 when I made the decision to go full-time real estate investing, which was actually 2003. I had guys and gals coming to me saying, Marco, you're buying a lot of property. I love what you're doing. I want to do it too. And I'm taking the same courses and boot camps. So could you coach me? Could you mentor me? Could you, help me? Unfortunately, I didn't have the time. I was very busy. So I nicely apologized and said, no, I'm sorry. I don't have the time to mentor you or coach you along. But I see a lot of deal flow. So why don't I pass along the deals that I'm not buying to you, and you can choose to invest in those if you want. So that's the light bulb moment. That's when I realized, oh my gosh, there's a huge market out there for people who are spending time and money educating themselves, but really are not pulling the trigger. And guys like you who do syndications help those types of people that want to be invested in real estate, but don't have the time or the resources or maybe the knowledge. And so that's where I wanted to come in. I wanted to be the guy at the end of the food chain where everyone comes and say, yeah, I'm interested in real estate investing. I love it. I'm going to study it as much as I want. Now I need to find the deals. So you're a deals guy. I'm a deals guy. And as long as you have the right team and the right deals, you're going to be successful.
100%. I mean, that's what it's all about. I mean, it's funny because, well, even aside from finding the deal, also operating a deal too, which you also handle that as well, right? The actual back end of taking care of the asset post-purchase, right?
Right.
The whole 9 yards. Because acquiring is easy, running it is another story. But let's take a step back. Let's take a step back. So you're buying stuff all over the country then, you'd mentioned, right?
Well, personally, I'm investing in multiple markets. You know, I believe in geographic diversification. In fact, I have a saying to be market agnostic. You should never be married to any one market, because the country is made up of 405 MSAs, metropolitan statistical areas. So what happens in Akron, Ohio is different than what happens in San Francisco, California, which is going to be different than what happens in Houston, Texas. So when you understand that all real estate is local, what happens in one market is going to be more than likely different than what happens in another market, because the fundamentals are different, the dynamics and the supply and demand is different. Now you can step back and be objective about your investment decisions. You can say, okay, I'm going to choose those markets over there because they provide cash flow, they provide appreciation potential, they have a healthy housing market, economically it's very diversified, et cetera, et cetera. That's the approach that I take personally. That's the approach that we teach, and that's the approach that we suggest investors that work with us or clients take as well. Because I want my money to work as hard as possible for me. I want it to be safe in the right market, but I want it to produce cash flow immediately and long-term growth. And I think syndicators look at it that way as well. But really, think about it objectively, not emotionally. Anybody would agree to that. I don't see why anybody would want to not follow that philosophy or that strategy.
Yeah, 100%. I mean, when you're saying market agnostic, it sounds to me like you're referring to not only like primary, secondary, I'm assuming you're doing tertiary markets as well, but you're also identifying cash flow markets versus appreciation markets, and really adjusting your acquisition strategy depending on what type of market you're in, right?
Yeah, so that's a great question, and it shows to me that you're a thinker, you're a smart guy. We classify markets. Yeah, well, we classify markets two ways: cash flow and a growth market. And then in the middle, if you kind of take the best of both worlds, it's really a hybrid market. A hybrid market is usually a boring sleeper market that is transitioning into a growth market. So you still have the benefits of cap rates and cash flow, but now you're seeing above normal annual average appreciation rates in that market. And so it's going into what I call a wealth phase. So when you have that growth, the upside potential and the cash flow, you have the best of both worlds. But investors, every investor is different. Some investors are at a point where they just want to invest in the best cash flow properties they can, and those are going to be in the cash flow markets because they're all about income. It's an income approach. Well, as other investors want to be in acquisition mode and growth mode, and they're going to give up or sacrifice potentially some of that cash flow because they want the higher appreciation potential from the markets that are growing strongly, because they know that in 3, 5, 7 years, they're going to take those gains in equity and reinvest them, whether it's through a 1031 exchange or whether they sell or refinance those properties to pull some of the equity out to reinvest it later. So different people, different investors have different investment goals and philosophies or strategies. And depending on what they want is, what we would end up talking to them. And, even as a syndicator like yourself, you probably have, you start with the end in mind. What do I want to accomplish in 5 years or 7 years? So if that's growth, you're probably going to look at a market, let's say, hypothetically speaking, in Jacksonville or in Florida, like Jacksonville, Florida. But if you want cash flow, maybe you're going to focus on a market in Ohio, or let's say Memphis, Tennessee, or more of what I call a boring market, not to, put the markets down, but essentially they're very slow, cyclical, predictable markets, but they're consistent in the types of cash flows they produce.
Right. And that's the thing, though. That's a strategy that we're employing right now in the markets that we're in. All we do is cash flow markets for the time being. But because to do those appreciation, those growth markets, they can be tricky. If you get in at the wrong time, get cold cocked, next thing you know, it could drop too. Because the same way that goes up, it can also fall, right? I guess it depends on the market, I suppose. But now these hybrid markets that you mentioned previously, that's interesting. How do you identify those types of markets? Those ones, I think those ones tend to elude a lot of people. It seems to me like many people are trying to find those types of unicorns, right?
Yeah, well, they're actually not unicorns. They're just markets that are experiencing reasonable rates of appreciation. Keep in mind that if you look at a big market, like, any kind of tier two, even a tertiary market, but a market like, Houston or Jacksonville, Florida, a second tier, what I call a second tier market, they're not like New York, Manhattan, San Francisco, that size, but they're markets that are still relatively large and experiencing growth. Those markets tend to, at some point in time, transition out of a reasonable 2, 3, 4% rate of appreciation on average per year. And for some reason, whatever it is, it's usually strong demand, lack of supply and strong demand that pushes them over this threshold where they start to produce 5 to 7, 8% annual appreciation rates. Now that's a growth market because that is not sustainable long term. Some markets even hit double digit. You can't keep appreciating that much that long because your income, the household income doesn't grow that fast. So if your income doesn't keep up with the price of real estate over the years, the markets become unaffordable and they become a San Francisco where it's maybe not quite a bubble market, although that's arguable, but it becomes overpriced and expensive and most people can't afford it. So you have affordability drops into the low teens, and that's terrible. But when a market is appreciating above 5%, that's pretty healthy. That's very healthy. You're going to see, because it stacks on very quickly. Like if you hold a property there for like 3, 5, 7 years, it's a measurable gain in equity from that appreciation. And meanwhile, if you have a decent cap rate and it's producing good cash flow, well, now you have the best of both worlds. So that's what I would refer to as a hybrid market. At some point, that market is going to top off and the appreciation is going to, normalize. It'll come back. It's regression to the mean. It'll come back to its historical norm. And usually that's the real rate of inflation. So it might be 2 or 3%.
When you're trying to build out a model, then do you typically include a mix of these different markets, or how do you typically, I guess, if a new investor came to you and said, here's 200 grand or whatever it is, here's the amount of money, here's X. Do you put them into different markets? Does that play into your overall return strategy, or do you come up with something that just allows that person to invest in that one deal? How do you typically put something like that together?
So it's entirely dependent upon the investment goals and plan for that client. So before I can answer that question, I have to basically point out that every investor is going to be different, unique, and individual. So, they have common goals, but the roadmap that we probably discuss with them might be slightly different. The destination is usually similar. And so it always starts off with, let's say, a 1-hour strategy session. If it's basically a free consultation where we find out where you are, where do you want to go, how do you want to get there, how fast do you want to get there, what's your risk tolerance, what's your investment capital like, how's your credit. We're going to look at the landscape and then just say, okay, the best path for you is going to be either from doing this or doing that. And based on that, we can say, okay, well, here's how we get there quickly, efficiently, effectively, intelligently, objectively. We build out that roadmap. It's not complicated, by the way. It's basically creating a roadmap around your investment goals, and it really is about goals, not what your wish is. It's what is your goal to get there. But I have a general rule of thumb, and interestingly enough, everything we've talked about over the last 10 minutes, they all plug in to what we were talking about just before we started recording here, my 10 rules of successful real estate investing. So indirectly, we're actually talking about all of my 10 rules for successful real estate investing. So more specifically to your question, the answer is that, well, first of all, I did answer it. It is unique to every investor, but I'm going to share a rule of thumb. A general rule of thumb that I have, and this is a starting point, you morph it however you want. but I call it 3 to 5 in 3 to 5. And what that means is you invest in 3 to 5 properties, and they could be any kind of property, whether it's a single family home, duplexes, fourplexes. You can measure it by properties, or you can measure it by units like doors. But 3 to 5 properties in 3 to 5 markets. And the reason for that is, for most people, that builds a very solid portfolio, a solid foundation, diversified geographically across 3 to 5 different markets. You have a good footprint in every single market, and these are all under professional full service property management. So those 3 to 5, maybe 7 properties in that one market is all managed by a professional management company. And then you move to another market, usually in another state, to diversify geographically in that second market. And then you do that a third time. So now you're probably in 3 different states. You have anywhere from, let's say, 9 to 15 properties. Some people do this over the course of 12 months, and some people do this over the course of like 8 years. Regardless of what it is, you know how many properties you need to be able to achieve your financial freedom goal. If that's $5,000 a month passive income, $7,000 a month passive income, whatever it is. So you reverse engineer it. You say, okay, here's where I am today. I want to retire on $10,000 a month passive income. Here's how I do it, and we break it down. But ultimately, you spread it out over 3 to 5 markets, and you build a strong portfolio.
That's a similar approach to how we do things, where when we're talking to an investor or somebody wants an LP on a deal, we want to get an idea as to what they want to do, what their goal is, and then back it into the right deal. Because not all deals are for everyone, right? Some deals, like you said, some deals are cash flow deals. It's primarily what we do out here. Sometimes we get appreciation deals. You know, we're working on a very large project right now in downtown Cleveland. Now it's going to be very much a growth deal right there. It's going to be a remarkable deal when it's completed. But different investor for different deals, right? So that's one of your rules. What other rules do you have for the audience out there?
Well, it's worth mentioning that the first rule, specifically the first rule for a very important reason, and that is educate yourself. You know, you can think of knowledge as the new currency. It really is what you build everything on, is what you can invest in and spend. See, if you don't educate yourself, you're essentially doomed to follow other people's advice. And the problem is you don't know if the advice you're getting is good or bad. And then you don't even know what kinds of questions to ask, because you don't know enough to ask intelligent questions. And this is what most people do, is they just blindly follow other people's advice, or they may invest in mutual funds or stocks where they have not only no control, but they're basically handing over, you know, a lot of their life savings and letting other people make those financial decisions for them. You need to educate yourself. You have to be knowledgeable. And the other thing that knowledge does for you is it helps to turn you from being a good investor, hopefully not going from bad investor, but a good investor, to becoming a great investor. And when you become a great investor, you know how to create deals and make good deals better. And with that, you can create those passive streams of income. And that's the important thing, is because unless you have passive income, you will never get to financial freedom.
And well, you know what, Marco, you just touched on something too. People just dump their money into a mutual fund or 401k or whatever. And I think that's because we've all been conditioned to do that, right? When I know when I was working in corporate America, that's what you did. No one ever talked to me about investing in real estate or anything else like that until I learned about it on my own. And I think that's probably one of the biggest mistakes that are happening out there, is the social conditioning aspects of things, right? Where you're just told, throw your money into this 401k, nothing to think about here, just move along, keep doing your 40 hours and you'll be fine.
Right.
Man, terrible. But the education side of things is huge. I mean, that's why we do what we do, right? As far as our shows are concerned, you know, getting the message out there about what's possible and how to help people change their lives through the material we put out there, right? A lot of it is just free. We just give it out to people, you know, and in the hopes that we're helping them achieve their goals. That's really what, I mean, that's what I do anyway. I don't want to speak for you.
No, I agree with you 100%. I mean, I think we feel the same way about it. And, you know, we both believe in hard assets like real estate, you know, being the greatest wealth preserver and certainly one of the best wealth creators. So real estate is my favorite. I have 2 favorite vehicles, and real estate is one of them in terms of wealth creation. But you have to figure out a way to create passive income, because, you know, Warren Buffett really said it best. He said, if you don't find a way to make money while you sleep, you will work until you die.
Yeah. What other rules do you have?
Well, we touched upon the whole thing about setting investment goals, and really that is critically important. A goal is different from a wish. A lot of people wish they were rich, but the reality is 99.9% of those people will never become wealthy or rich. Yeah. So you have to be honest with yourself. You have to set clear, specific, measurable goals, what they call SMART goals, specific, measurable, attainable, realistic, time stamped, time sensitive. But those goals can be turned into a task list. And that task list, wow, that's a tongue twister. That becomes your action plan. So you got to create a roadmap for yourself. And, we help people do this. So it's, most people don't know how to do it, but it's not that complicated. But, if you create an action plan for yourself that shows you how to get to where you are today off the sofa, and, to a place of financial independence where you have time freedom to do what you want, when you want, how you want, on your own terms, that is really how you become financially independent. So you do need to set investment goals and make them clear. And the more clear they are, the better off you're going to be. So that's number two. That would be my second goal. Do you want me to just kind of roll through some of this?
Yeah, go ahead. No, please. This is good stuff. Yeah.
So a mistake a lot of people made back in 2000, from about 2000 to 2006, before the housing market imploded. A lot of so-called investors, and I say that in air quotes, thought they were investors because they were buying properties that were appreciating. Well, a rising tide floats all boats. You could be, deaf, dumb, and blind and make money or equity in real estate when you have a rising tide like that. But that is not investing. That's called speculating, and it's akin to gambling. And so, my third rule is to never speculate. You always want to invest with a long-term perspective in mind. You want to invest for cash flow. Cash flow is king. Yeah, we want equity and appreciation, but you're going to get that if you invest intelligently. So markets ebb and flow. They go through cycles. There's peaks and troughs. Some markets more than others, like San Francisco or coastal California, may be far more cyclical than, let's say, Memphis, Tennessee, or the markets where you live, in Ohio. Those being what we call linear markets. Don't invest for the sake of just trying to hit a home run from an appreciation perspective. That's called speculating. Cash flow is critically important, and that really segues into my fourth rule, and that is invest for cash flow. I refer to cash flow as glue. It's the glue that holds your deal together. So your property is going to grow in value over time. Well, price. The value may increase, but price will increase. And you will gain from cash flow. You will gain from equity growth, equity from amortization, equity from appreciation. But to get to that point, month after month, year after year, you need cash flow to keep your deal, your property, carrying itself, floating itself. And while time goes by, that cash flow is investable, it's spendable, it goes in your pocket. But now you have equity growth in addition to that cash flow. So invest for cash flow first, and the other things second, and it'll all come together for you very, very well. Any questions about that?
No, that's 100% true. I mean, that's exactly the strategy that I employ when I'm talking to my students, and even when I'm talking to our limited partners. Is that what you're looking for? Is that you can never call it a sure thing, but that cash flow. That's why we call the show Bulletproof Cashflow, right? So the reason why we do that, it's like, yeah, it's we're looking for the cash flow. It's a bulletproof net worth.
Yeah, it's a great name. I love that title. I think you hit it spot on.
Thanks.
So the fifth rule is what we already talked about, and that's being market agnostic. Again, I'll reiterate. If you look at the major metropolitan areas, the MSAs in the United States, there's 405 of them, or at least I track 405. If you include the micro markets, there's hundreds more. The point of it all is that it's a big country made up of many independent markets, and all these markets are driven by local factors. Whether it be the politics, supply and demand, the median price, median rent. These are all factors that drive these local markets. And so you should only invest in markets that make sense to invest in, where you've got inventory, the right team, growth potential, strong jobs, job growth, population growth. And really those are at the heart of it. It's jobs and job growth and population growth. Those two things are the strongest dynamics or factors that drive a real estate market. So if you just look at nothing else but those two things, assuming the numbers make sense, like you can generate cash flow and a decent rate of return on your investment capital, you've probably licked 70 to 80% of all concerns, fears, risks in your investing. Of course, you want to be in good neighborhoods, but
well, there's that, and well, there's also the team as well, right? I mean, sometimes you can. I mean, I don't know how often that was going to happen, but if you have the jobs and you have income and all that fun stuff, but if you can't find a decent team to operate it, then you're gonna have some trouble down the road, right? I mean, that's probably one of the biggest things when it comes down to selecting your market, right?
Yeah, well, team is critically important, especially your property manager. He's the number one person on your team, because I jokingly say you live and die by your property manager.
Mm-hmm.
Management is critically important. You have to have the right company, team, person, whatever it may be. Otherwise, you might be in for a rough ride until you actually find the right person. So you do want to be market agnostic, and I think we talked about that enough. So the sixth thing is you want to take a top-down approach. A lot of investors make the mistake knowingly or unknowingly, mostly unknowingly. They get shown a deal, and it's a property, and they underwrite and evaluate it. They look at everything about it, the photos, the renovation, even do inspections on it. They look at the past performance, the rent rolls, the pro forma, and they love the deal. But they make the mistake of looking at the street it's on. There could be burnouts, dilapidated properties, a lot of crime, the neighborhood that it's in, and even the market that it's in. That's going in the reverse direction. You got to think of it like a funnel. You start with the market first, then the sub-markets or areas, then the neighborhoods, then the properties. If you do it that way, top-down approach, you will eliminate a lot of problems, risks, and issues down the road, well, immediately. So you have to start with the market in mind and work your way down. It's not the other way around like a lot of investors do, because they know investors are investing in a particular market, and they think it's the hot spot to be. If other investors are investing there, I should be investing there too. Well, no, not necessarily. Again, step back, look at the whole big picture, ask yourself the questions of, what am I trying to achieve? Where should I be investing to achieve those goals? And what markets make the most sense, etc.
Excellent. Now, as far as data sources to figure all that stuff out, where do you get your data to look at, like, neighborhood level information or income level or things like that?
So tons of free resources online. A lot of this information, believe it or not, is actually available for free. A search engine like Google becomes your best friend, because if you start typing in certain markets like Cincinnati, Ohio, followed by another 2-word or 3-word phrase, market forecast, housing forecast, market trends, real estate trends, unemployment, migration rates, job growth, following the city and state, of course. So 4 or 5 word phrases that you search for will pull up tons of articles. Then there are also websites that make for good tools, and there's a plethora of them, from probably the most basic and simple one that comes to mind for most people, which is Zillow. Zillow has some tools on there where they show you market price and trends. A very basic 1-year forecast, however accurate and inaccurate. Keep in mind, these are very broad level, because they're talking about an entire market which may be 7 million people, and you have to narrow it down to sub-markets within sub-markets. Could literally be at a neighborhood level, which is another tool that I use and endorse. In fact, I helped shape neighborhoodscout.com. I don't know if you've ever heard of it.
Oh yeah, I heard of it. Sure.
So I helped Andrew shape that tool to be away from a homeowner's tool to an investor's tool, because I basically said, you've got the data, but now give me the reporting and graphs and materials that I need as an investor to understand the real estate market, the demographics, the trends, etc., that are going on. So that's just one an additional tool. There are a lot of, Redfin has some tools, Trulia has some tools, heat maps, crime maps, school ratings. There's walkability scores you could look up. I mean, when you start doing a search engine search, you'll find tons of stuff.
Excellent.
And I have things bookmarked. I don't remember all of them. In fact, I got to the point where I have my staff do a lot of my research now.
Well, yeah, I mean, it's easily replicatable. I think as long as you're able to put it all in one place and then possibly even organize it. So it sounds like, though, if you're able to pull the data and then try to find cities that match that data, the data, how should I put it? I guess the template,
I'm looking
so to
for,
speak, right?
Yeah. I mean, I track data on 405 markets. The data is pulled in from different sources, and then I can look at it kind of like in a spreadsheet or tabular form.
Yeah.
And then I can sort and filter. But it tells me where a lot of the great markets are. I'll give you a quick example. We weren't in this market before, unfortunately. Now we are, fortunately. But Idaho, a lot of the Idaho markets have been on fire. Idaho has been just a great place to invest for cash flow, and now it's been for a number of years now exploding. So I mean, it's a lot of the Idaho markets are actually in the top 10 for growth in the country right now.
Wow.
For various reasons, but that market's just been on fire. So we're building new construction fourplexes there, and I believe triplexes as well. But so someone looking on the growth strategy, right? Looking for a strong appreciation potential, they're getting it, but strong appreciation plus the cash flow, that has been the market to be in for the last couple of years.
Excellent. Yeah. See, that's the thing. I would never thought about Idaho.
Well, yeah, who would have thought Idaho? I mean,
who would have thought?
We're just growing potatoes there, right?
Well, people got to live somewhere, right? So, but yeah,
exactly.
That's the thing. I think that's the thing. Yeah, right. I mean,
exactly. It's all about housing.
Right. Well, you mentioned Florida. Florida's been on fire now for a couple of years at least, especially Orlando. Orlando's been on fire for quite a while. And I would imagine, though, that someone early on figured out that is indeed a growth market, and it is, and it's doing quite well now. So I think now it's to the point where, now it's getting a little bit overpriced. So now, how do you know that when your data, or does your data show when things are getting over their ski tips and things are about to fall over? Are you able to determine that? Are you able to anticipate that based on this data?
Yeah, I mean, at a 30,000-foot level, one of the things you look at is its affordability. When affordability starts to tank, then you've got headwind. That doesn't necessarily mean the market's going to slow down. That's the interesting thing about real estate, because if you have a strong job market and people are still moving in, so you have population growth, they need a place to live, and so that demand trumps the affordability. Okay, and that's why if San Francisco is hit like the $1 million price point for a for a 1-bedroom condo, it's ridiculous. But it's because there's limited supply and a lot of jobs, so strong demand. So affordability is one thing. That's probably one of the main things. The other thing, as far as a tipping point, would be, I mean, they all kind of lead back to affordability. But as long as you have jobs and job growth, you're going to have that sustained drive pushing forward regardless of the headwind.
Right.
But when that starts to thin, then you're going to have problems, because then you start to see inventory levels go up, prices start to soften, potentially if they're overpriced and unaffordable, that's when prices start to come down. And we're starting to see that in expensive markets like Vancouver, Canada, San Francisco, San Jose, I believe parts of New York. So, overpriced markets.
Interesting. Okay. Let's keep going through the list. What are we now?
Yeah. So number 7, we talked about, it's diversification. You want to diversify across markets, right? We kind of beat this one up pretty hard, but
yeah,
focus on one market at a time, but ultimately accumulate, 3 to 5 income producing properties per market. And, often those are separated by different states. So, that really helps to reduce the so-called risk in real estate. You're not going to be impacted by economic cycles and market cycles and real estate cycles within one particular market if you spread out that way. So number 8 is again, use professional property management. Property managers are critically important for your success. It's a thankless job. It requires a solid understanding of the tenant landlord laws, good marketing skills, people skills, how to deal with tenant complaints and excuses, your ability to properly screen and qualify prospective tenants, bring them in so that way you eliminate potential problems down the road. Your time is better spent with your family, your career, enjoying what you like to do, your hobbies, and looking for more investment property if that's what you enjoy. So spend your time there, not managing property, unless that's what you do for a living, then fine. But I think professional property management is critically important.
That to me is actually the first person that you look for. That's what I recommend to all of our students that's hire number 1. Find a great property manager that you like and likes you back and you can work with long term, because that's a relationship that can help you not only run the asset, but can connect you with other people out there that can help you close deals as well. So that's absolutely critical, and that's probably a tough thing to do, because a lot of property managers get a bad rap. I mean, that's probably one of the biggest problems in the space is the operational side, right? Unfortunately, that's one of the big things, right? I mean, how do you identify a good manager? What do you guys do?
Well, we vet them. We vet all the service providers we work with, because those are the resources we freely pass along to our clients. I mean, they're already plugged in. It's not just the properties, but they're plugged into the property manager, the lenders and mortgage brokers that we work with. They're plugged into the asset protection attorneys, the tax advisors, and of course, we are an acquisitions source for them. We'll have anywhere from 1 to 200 properties available for purchase at any given time. So in terms of deal flow, we've got that widely covered. Those are the 5 key people on your team. Mm-hmm. But we vet those people and we work with them. We have a history, often like for years. And so we're comfortable in recommending, referring them and connecting you to them. But we're also just as quick to fire them if and when needed. And it doesn't happen very often, but probably once every 2 years, I have to fire a company, maybe 2, but one company, because they've just gone off the rails. Yeah. So you can do it on your own. I mean, we've already done it for you, but doing a lot of research online, references, referrals are helpful, but checking references, looking at online reputation is an important way to go today. I mean, so much is online. Now, granted, some of it's fabricated and embellished or even lies, but on average, you can, cut out some of the 1-star and 5-star reviews and kind of look at what people are saying in the middle. And that should give you a pretty good idea. And then, you talk to them, see if there's chemistry, ask questions. This goes back to rule number 1, educate yourself. If you're educating yourself, you have the knowledge, you know what questions to ask. You'll ask the right questions. You'll be able to build a level of confidence and screen the right people the right way. You're not coming from a place of ignorance, because a lot of people think ignorance is what? What would you say? Ignorance is what?
Bliss. Ignorance is bliss.
Right. It's not. Ignorance is expensive.
Right. That's right. Sure is.
Okay. So knowledge is important.
Knowledge is important. Yeah. And then we got, was it rule number?
So we're at number 9.
Number 9. Yeah.
Okay. So this one needs to be taken with the right perspective, because it's about maintaining control. Now, I'm not referring to what I'm referring to is mostly Wall Street, corporations and fund managers. I'm not referring to syndications, because with syndications, it's a group investment. There's still a direct level of ownership in the real estate, the hard asset, and if you trust or know the principles, you're working as a partnership, as a group, and so you have that level of control. But what I have is an issue taking investment capital and throwing it to Wall Street, throwing it to 401 mutual funds, and fund managers where you don't know who they are, you have no direct contact with them, you're relying on their decisions to make the right decisions for you as an investor, and you have virtually zero control. So ultimately, you end up investing in paper-based investments, right? I like to invest in hard assets like real estate. And whether it's me by myself, or I have a partner, or I have 50 partners, and we're all in a 400-unit apartment building or a single-family home, I don't care what it is. You have the ability to maintain control, and that's the beautiful thing about real estate. Is it's a hard asset, and you have title, you have ownership. You don't have that on Wall Street. You don't have that with paper assets.
That's right. No, that's why I love it too. It's kind of like right at the beginning when we were talking. We're convinced that we need to just throw our money into a 401k, and we're also taught to relinquish control, right? Let someone else handle it. Don't get educated. Totally ignore it, right? And totally the wrong way. Totally the wrong way. That's why, yes, I'm the same way. Everything I have right now is all tied up in real estate. Everything. I don't do any Bitcoin. I don't do any stocks. I don't do any of that stuff. It's strictly real estate.
Yeah.
And
well,
just go deep in it. Yeah.
Well, that's smart. Good decision for you. I mean, that's smart, right? Because you know it works.
That's right. Exactly.
It's worked for decades, right?
And you have control of it. You have control of it too, right? I mean, we can take an asset, we buy an asset, we put in the work to make it better. We drive the rents up. We create a better atmosphere for the tenants to live in, and they're happy. They'll gladly pay more rent because they like the safety that it brings, and they like where they live. I mean, everyone's happy. It ends up being a win-win-win for everyone. Why wouldn't you want to have that type of control as opposed to just handing it off to Wall Street? No offense to the guys on Wall Street, but you never know what's going to happen that day. Someone could drive the stock up because they put some fake news article. There we go.
It happens every day. Absolutely.
Happens every day. Yeah. Happens every day. Yeah.
So in kind of wrapping up these 10, ask yourself this question: where else can you put down 20% of the purchase or of a piece of real estate, whether again single family home, fourplex, or a large apartment complex? Where else can you put down a relatively small down payment like 20% and borrow the other 80% of the funds to control and own that asset, yet at the same time maintain 100% of the control, 100% of the cash flow, 100% of the equity growth, 100% of everything, 100% of the tax benefits, only in real estate? So the 10th rule is to leverage your investment capital. Why? Because you can actually borrow other people's money, purchase and control income producing property, have 100% of the benefits while only putting as little as 20% down. That's amazing. You can't do that with anything else.
Not only that though, Marco, I mean, for our listeners that are outside of the country, what we can also realize is that you can invest in deals here in the States the same way that you can't do it. You can't do it in Canada. You can't do it in South America. You can't do it anywhere else. And to even push it further, there's only certain states you want to be investing in too, and certain cities that you want to be investing in as well, where you can apply the same sort of rule. I mean, you can't do that just anywhere. You can only do it here, which is remarkable.
The United States is a unique country in the sense that we're one of the few, and I want to say the only, but as far as I know, there is one other country that has a similar loan product, but we're essentially the only country that has a 30-year fixed rate mortgage available to the population. That's unheard of. I mean, the second best is probably countries like Canada, where you can get a 25 to 30-year mortgage. That's the amortization period. But you have usually a maximum of 5-year terms. So after the 5 years, it's essentially like refinancing the mortgage. You're starting over. You have to recast that loan. Granted, your principal's lower, but you're starting all over again, requalifying for another 3 to 5 years at a different rate. But here you can lock in for 30 years. And that's not inflation adjusted. Inflation is your friend. Inflation is eating away at that 30-year mortgage each and every year. So my $500 mortgage payment on my 3-bedroom home is $500 today. But guess what? In 15 years from now, I'm paying $500. So it's going to be the same price as a damn Starbucks, 15 years from
now. That's true though, right? Yeah, exactly. And man, and that's why That's one of the things that many people don't understand is the inflation that keeps eating away at the dollar every single day. You're right. It improves the buying power. It actually reduces the buying power, so to speak, but it improves the overall value of that declining asset that's in your pocket right now. It's crazy.
Right.
It's crazy.
Right. Exactly. So leverage is a powerful thing, and it's very advantageous for you as a real estate investor because it magnifies your overall rate of return and it accelerates your wealth creation because your fixed amount of investment capital can be, 4x, 5x across more property. And over time, that becomes more cash flow and more equity.
Those are awesome. The awesome 10 rules. We're going to have to list them out somewhere.
They're listed on my website.
Excellent. Yeah. Well, there we go. Okay. Well, we'll talk about that too. But before we go into that, I know you have you have a book that's coming out, right? Pretty soon, I hope. Yeah.
So the manuscript is actually done. It's in like final editing and graphics and all that kind of stuff. It's actually titled after the podcast. I wanted the same name for continuity. So it's called Passive Real Estate Investing. And it is going to be given away for free. So it'll be available as a download or a paperback. But in both cases, it's a free book. I want to give it away for free because it is there to help educate people on, it's more than a primer. It's basically, here's what real estate is. Here's why you should be investing in real estate. Here are the benefits of real estate. Here's how to go about it, whether it's a single family home or a syndication in an apartment complex. The benefits are the same. It's just the scale of what you're investing in. And it's meant to be kind of beginner to intermediate level. It's not an advanced book. I'll ultimately put out something that's more advanced at some point in time. But I just wanted to get it in the hands of people because my goal is to help 1 million people build passive income and create wealth using real estate as the vehicle.
I love that goal. Same sort of thing. We're looking to increase the reach of our brand as well to hopefully help people get into more real estate deals as well. Because I truly believe since I escaped the rat race and made my way in the world of real estate, that this is the only way where we can do just what we've just been talking about for the last little bit here is the way to true wealth. There's nothing else like it. Nothing else like it on the planet. Absolutely. Totally. So how do you see the next 5 years playing out for your business?
Well, we've been growing year over year. I mean, we're very busy. We're helping more and more people. I mean, right now we're on track to sell. When I say sell, it's really, help position in our investor clients into those properties that they all own 100% on their own, benefit 100% on their own. We don't share in anything. We're on track to break 500 sales, like 500 properties this year. Nice. So we do between 400 and 500 a year. 5 years from now, I'd like that to be between 1,500 to 2,500. On the road to achieving that mission, of helping 1 million people, we can't do it just through property. It's going to have to be through education.
Absolutely. Yeah.
So I want to ramp up the volume of content that we put out to help achieve that goal.
All right. Well, good. Well, guys, I'll tell you what, guys, if you want to reach out to Marco and help him reach that goal, you can reach him through his website at noradarealestate.com. Hope we got a lot of great insight on where real estate investing fits into the cash flow system and what you can do to build your own personal wealth. I will see you in the next episode.
Thank you for listening. We hope you enjoyed the Bulletproof Cashflow podcast.